Good morning, Bitcoiners. Hello, and welcome back to another edition of your Bitcoin Economic Calendar, the news you need to know for the week ahead in Bitcoin. Today is Monday, March 29th, and we have a really big week ahead in the markets. In today's issue, we're going to be talking about a new $3 trillion stimulus package that is coming out or is in the works out of the Biden administration. We're also going to be talking about the US dollar, which actually has been rallying since the start of 2021, and we're going to discuss the potential implications of an unexpected US dollar rally. And last but certainly not least, today marks the end of the commentary period for the proposed FinCEN law to regulate digital asset transactions. Any updates on that front are sure to affect the markets. So lots to cover. Grab your coffees. Onwards to our analysis. Starting as we usually do with Bitcoin, we see that expiration week certainly lived up to its expectations, with Bitcoin grinding lower throughout the week towards the maximum pain point, which is going to show here in the graph. So maximum pain point was the expiration day, which is 26 at 8 a.m. Eastern, or 8 a.m. UTC. This is the bar here of expiration time. So you can see that the market actually continued to grind higher over the weekend, but in fact, it did not. It was not able to close the week, or it was not able to regain the full ground from the drop throughout the week, and it still closed the week lower by 2.77% at 55,790. We do see that it is already moving higher this morning. However, just to touch on a second on the maximum pain point that we had for last Friday's contracts, which was the 44,000 level, just wanted to touch for a second on what that maximum pain point is. So the maximum pain point as far as options are concerned is the price or the strike price at which most financial losses are inflicted in the open contracts. So for the last set of expirations that happened this last Friday, the max pain point was at $44,000. So we see that Bitcoin actually had pressure and headed lower towards expiration, but then bounced back with literally 4 hours to go to expiration and essentially kept going. This is the expiration time here. So as you can see, after the contracts expire, Bitcoin was able to essentially resume its uptrend. And doing a little more of that this morning, looking quite strong in the morning. So in addition to that, if we want to step back for a second to the macro view, as far as Bitcoin's concerned, the directional trend of the US dollar money supply is very clear, regardless of whether there is Main Street inflation or not. The Fed and the US government will spend as needed to stimulate their economy. As we covered here a few weeks ago, more details are starting to surface about a new potential $3 trillion infrastructure plan that is being prepared by the Biden administration. That's the headline that you have on the back of your screen right now. So opening back the chart for a second, but with the continued stimulus with continued stimulus efforts and the economic indicators already pointing towards the recovery, there's a very interesting interplay right now between Main Street inflation and U.S. Treasury yields. Both affect the real rate of return. Essentially, the interest rate minus inflation will give you what the real rate of return of that bond is. And this is giving rise to very interesting dynamics in the markets impacting the US dollar, which could ultimately impact Bitcoin prices. We will dive deeper into that dynamic in our What's Ahead section today. Just to step into the Bitcoin options world for a second, these are the April 30th contracts for Bitcoin. And although we are still quite far away from the next expiration, which is April 30th, we are just wanted to point out some relatively large contracts that are already kind of sitting in significant open interest as far as strike prices. One of them is that $80,000 strike price that I'm highlighting here. At the $80,000 strike price, those calls have 5,300 contracts in open interest, which is not an insignificant amount. And on the put side, we see some interesting volume here at the $50,000 strike. So again, interesting to see this. Both the call strikes and the implied volatility on those contracts are relatively higher, but they're still, both of them are south of 100, which in Bitcoin world is relatively okay volatility. You see, as we start getting further away from the in the money strikes, you get into like the 100, north of 100 implied volatilities. Lastly, to look at the perpetual swap funding rates for a second for Bitcoin across major exchanges, we see that the current rates for both Binance and FTX are quite over their 30-day averages, which tends to be a sign of potential future volatility ahead for the week. So something to keep in mind as we head into the trading week. Moving over to the S&P 500, this is the S&P 500 chart, but we see that last week the yield on the 10-year Treasury notes took a breather and actually were down 4.16% for the week. And we also saw a reversal from the inflationary trade back to tech. This may also have been influenced by the narrative of rising infection numbers along with vaccinations in the US. You can see the article behind my screen right now, which challenges or can challenge the fully opened US economy view for this summer in the US. Going back to the chart, we see that the S&P 500 closed higher for the week at 1.68% to its highest weekly close ever, a new record on the S&P 500. The Dow Jones also closed at an all-time high, up 1.36% for last week. And the biggest winner, as we mentioned earlier, was the NASDAQ. So the NASDAQ was up 3.42% for the week last week. As we said, this may have been somewhat influenced by this view of a potentially challenged view of a potentially reopened U.S. economy, and essentially people repositioning back into a potential half-locked, half-open economic recovery, which should benefit tech. There's been a lot of attention, as we've been covering, on the reflationary trade going back to industrials and commodities, but we're seeing some of that reverse a little bit based on last week's actions. Commodities, as I mentioned, just to touch on those, you can see that both oil and copper have been on very clear multi-week downward patterns. And this is also interesting because at play as well with commodities was the fact that the dollar rallied tremendously last week and has been actually rallying since the beginning of the year. So as we mentioned, we will be talking about a potential implications of a surprise US dollar rally, just because it's not common to have to see US dollar rallying with all the talks of stimulus and all these new dollars being printed. So again, we'll touch on this later in our What's Ahead section today. But also coming up this week is we get unemployment data. And the Fed has been actually, this is something that the Fed looks at very closely to determine its monetary policy decisions. The unemployment rate, and again, the Fed will be watching this very closely, and so will we. The unemployment rate in the U.S. has been trending downwards, and the last read in February was of 6.2%. Now, last week, we saw a larger than expected drop in unemployment benefit claims, which could translate to a meaningful improvement on Friday's upcoming numbers. Now, this would be consistent with the views of the Fed. As we can see, the Fed estimates the unemployment rate will fall to 4.5% during the year 2021. So they're very much expecting this number to keep trending downwards. So again, a lot of eyes will be on this report coming up Friday. Bringing it back to the chart. Bringing it back to the chart. This backdrop of improving economic conditions around with a new conversation around a new $3 trillion infrastructure package should bode well for the markets, and in particular for the inflationary trade in the weeks to come. Moving over to gold, we see that it was basically down last week, 0.80% at 1,730. We also see that it seems to be continuing downward this morning. The move last week was consistent with that of a rising dollar. We see that the dollar was up by 0.89%, and gold was down by a relatively similar amount, down 0.80%. Now, the rising dollar, as we mentioned, also brought down commodities like copper and oil. Here's copper, and this one's oil. So as we can see, a rising dollar does put downward pressure on commodities like gold. Interestingly, what has been discussed a lot, or has been in the news a lot last week, was this blockage of the Suez Canal, which many of you may already heard of. But essentially, the talk around what this supply chain disruption would do would be that it could create a shock upwards on commodity prices. Now, we see that even that was not able to jolt commodities back into positive for the week. The weight of a rising dollar was just too much to bear for them. Interestingly, as we pointed out here last week, gold prices have been inversely correlated to the real long-term rates in Treasury bonds. This week saw a drop in Treasury bond yields the last week, meaning that the real return for Treasuries was under pressure as well. But counterintuitively, gold prices did not rally inversely as this real return came under pressure. So something to note as we continue to see shifts in that real rate of return because of so much information is hitting the tape around inflation expectations and Treasury yields. Moving over to the DeFi index, we see that the DeFi index actually took a beating last week, down 8.70%, underperforming both Bitcoin and Ethereum. And the DeFi index was down more than Bitcoin and Ethereum by a long shot during last week. As we discussed in last week's issue, this type of behavior is not surprising and consistent with the end of the commentary period for the potential FinCEN law to regulate digital asset transactions. The deadline for additional commentary in that proposed law is today. So as drafted, this will be most impactful to DeFi protocols, most of which do not conduct KYC or Know Your Client processes for their participants, nor do they follow AML policies, so anti-money laundering policies, because they do not essentially process KYC on their clients. So that in itself will not allow them to have very strong AML policies. Now, the market will certainly be on its toes as it awaits any further developments on this front. And while extending the commentary period again might keep the party going for a little bit longer, there's a good chance that the US government looks to move forward with some version of the proposed law. And a lot will depend on the specifics of that law. Now, looking at the Ethereum option markets, if we can try to find some insights there, we see that there is a contract that expires on April 2nd. There's an option set that expires on April 2nd. And if we look at the put contracts on that, there is a very interesting, there's a huge concentration of put calls in this 1440 range. Disproportionately, actually, 10,680 contracts. This is way more than there is an open interest in any of the other contracts. That are not, just for reference, we see here that 1840 level has 5,000 contracts. But essentially, this 1440 put block is by far the largest chunk of option contracts that are set to expire on this April 2nd expiration date. So something to consider as we head into the week. Again, the final day of the commentary period for the proposed FinCEN law is today. So it's very likely that we'll be hearing updates around this throughout the week. Moving over to our Bitcoin mining commentary, hash rate on the network has actually soared since last week, with the next difficulty adjustment currently signaling an increase of 5%, which should bring us to a new all-time high of 22.98 terahashes this Thursday evening. So it actually may come one day early because of how much hash rate has now come into the network in addition. Now, looking over at the mempool, things do seem to be getting slightly better. We're now down to, say, July levels, July 2020 levels. So although this has come down quite significantly and the network continues to gain hash rate, transaction times will still remain a little bit longer and more expensive than usual, so that you can plan accordingly. So as always, we leave you with what's ahead for the week. With contract expiration week behind us, the elephant in the room for the coming week is the end of the commentary period for the proposed law out of FinCEN, which happens to be today, Monday. This means that we will likely be hearing about updates on this front, or even perhaps a further extension to allow for more commentary. Any headline around this will certainly move the markets. On the macro side, Treasury yields were down for the week last week after moving higher for 8 consecutive weeks. So they seem to have found buyers at these levels. Bonds seem to have found buyers at these levels. Whenever there are buyers coming in to bid up the bonds, those yields come down. So, and some market commentaries have highlighted that the 2-year bond auction last week had solid demand, but there was a decline in foreign buyers. Now, this may be about to change. So as we have noted, Treasury yields are rising faster than inflation indicators. This means that the real rate of return for Treasury bonds is becoming less negative and creeping up towards positive. The real long-term rate for the 10-year note, as per the Fed, started the year 2021 at negative 50 base points and is currently at negative 6 base points. So again, it has been rapidly ramping up from less negative and increasingly becoming less negative and creeping up towards being positive. This could be what's driving some investors or more investors to buy dollars, perhaps in anticipation of a positive real yield in US Treasury bonds. The US dollar has been rising since January this year, as we have highlighted, which is exactly when the yield on the 10-year note broke out as well to the upside. A rising dollar could damper the Fed's domestic inflation plans. And one tool that the Fed could use to discourage dollar demand is to artificially keep Treasury yields lower. This type of action is known as yield curve control. It's already being implemented in countries like Australia and Japan. You can see links to some articles in the blog piece or the blog version of this article. We will be diving deeper into yield curve control in our next issue of the Bitcoin Economic Calendar. But for a second, let's talk about how this could impact Bitcoin. You can think of yield curve control as a way of forcefully trying to bring down the attractiveness of owning US dollars by altering the economics of earning a positive real rate from the most secure bond in the market, the US government bond. Now, while the Fed can do this by artificially keeping the yields on these bonds down, by them themselves going out and being the buyers of these bonds and not allowing them to get over a certain threshold, it's harder, they have a harder time, the Fed does, unwinding the effects of its policies on assets like Bitcoin. So in other words, the Fed can try to put makeup on some of the problems created by its monetary policy to drive certain behaviors, but it cannot change the fact that it is in fact injecting more units of money into their money supply, and that eventually that should drive up asset prices. Now, it's a big week coming up, and as always, we'll keep you posted on any relevant information throughout right here, the Bitcoin Economic Calendar, and our social media at Hodl with Ledin. If you learned something today, if you enjoyed the show, I welcome you to like the show, subscribe it, share it with your friends. If you don't yet have a Ledin account, I welcome you to check out Ledin.io and learn how you can start earning 6.10% APY on your first 2 Bitcoin and 12.5% APY on your USDC. Thanks, everybody. Have a wonderful week and see you next time.